Okay, it looks like it is 1 o'clock Central, so I think we'll go and get started on our session today. Welcome everybody to our worksheet S-10 provider training for the upcoming 2021 audits. And this deals with the cost report periods beginning in federal fiscal year 19, so beginning 10/1/18 through 9/30/19. And I'm going to be presenting some of this, and then Ron Wolf will be presenting as well. This session is being recorded, so anybody that needs to review this later on, or if you want to pass the link on to anybody else, you can certainly feel free to do that. The recording generally will be available by tomorrow, the next day. So let's go ahead and get started here. Just as an agenda, now this is similar to the agenda document that I sent out before. We're going to go through the overview and time frames related to the S-10 audits, the cost reporting instruction overview, and that'll make up a pretty good chunk of the time for this session. Then we'll talk about the charity care and financial assistance policies, cost reporting templates. We'll spend some time going through those, what to expect with the actual Excel spreadsheet, the charity care questionnaire that comes with it, all of that. And then we'll spend a little bit of time on something that some of you may not have had a chance to use yet. It's the new secure EDI portal that we're going to be using for this year to submit the documentation. It allows for larger file sizes. And then we have a little section just giving some additional information on the audit process and some special points about each of the three main elements of this uncompensated care audit. We'll talk about the available resources, and then our goal with the 2-hour session is to have some time for questions. So the first thing I wanted to mention is that a lot of this material we've already presented in previous years. We've already recorded in the YouTube videos that we have out there. However, what we really wanted to do was bring it back up, allow everybody a chance to ask questions live, and of course, add any new information that's come up over the past year of audits or so. So that was the goal for this. By the way, I do have the chat area opened up on the side, so I'll be able to see any questions that come up there, and feel free to ask them during the discussion. That way they're relevant to that particular topic. And then of course we'll have the section at the very end for anybody else that needs to see questions also. So hopefully that helps to clarify that. Let's get started on slide 3 here. So just a little bit about the overview and time frames. For the prior year audits that we just wrapped up, December 31st. So, let me mute everybody here. Somehow somebody got unmuted. Hopefully that helped. Looks like some people are still not getting muted somehow. So we'll try that. If anybody is on, hopefully you're not able to speak when you're muted, but if possible, put your phones or your microphones on mute as well, just in case. So the prior year audits, we have the fiscal year 18 audits, the fiscal year, the cost report periods that began 10/1/17 through 9/30/18. Now those again wrapped up December 31st. I have to be used for with question marks. And the reason I say this is that nothing is final at this point. We can speculate or we can, guess at what we think CMS is going to do with these. It's probably a fairly educated guess. We're saying these are possibly or maybe even probably going to be used for the S-10 Dish Uncompensated Care Factor 3s that will be published in the federal fiscal year 2022 Federal Register. That's going to be coming out next month, maybe in May for proposed, and then of course August for final. That's our guess at what it's going to be if they continue with the past pattern. I'd be surprised if it's not this, but again, nothing's final until they issue it. So that was the last year's audits. The current year's audits they're the ones fiscal year 19, beginning 10/1/18 through 19. So those are starting. Basically, we're using March 5th as the start date because that's when the request letters went out. And the final audit, I got a big typo there. The final audit work is due on December 31st, 2021, certainly not 2011. Missing a number there. That's December 31st. That's the goal CMS has set really for this year going forward. And again, this is 2 years out. We expect these to be published in the federal fiscal year 2023 final rule, but that won't be for a little ways down the road. Again, this is all subject to change. This is just our guess at what this will probably be. And of course, the factors threes that are listed there, that means they're going to be relevant for that federal fiscal year's uncompensated care payment. So continuing with the overview, this is the second year of S-10 audits that have included 100% of the hospitals that have reported DISH, and that's on E-Part A, line 34 of the hospital cost report. Now, prior to that, for a few years prior to that, there were just samples of providers selected based on risk assessment, but now we're in the second year of 100% of hospitals. The same cost reporting instructions have applied for these past 2 years. We're a few years removed from the last changes, so that's good. We should see some consistency there. And just the fact that, again, all hospitals, except for, of course, brand new hospitals this year, all hospitals have had a chance to go through one round of audits. So hopefully there's a little bit of a learning curve to it. Hopefully this is starting to become a little bit more understandable. No major changes between the 2 years. Now, I do want to make a point here. When they use the term DISH eligible hospitals, at first glance, that's a little bit ambiguous, because DISH eligible, you could argue one way that, hey, every acute care hospital could potentially be DISH eligible. And you could also go the other route and say, well, what about only those hospitals that are truly reimbursed DISH? Regardless of whether they're eligible, were they really reimbursed for DISH? Specifically, the Soul Community Hospitals come to mind, because in many cases, Soul Community Hospitals have a hospital-specific rate that is already higher than the federal rate that's going to be used that includes DISH and uncompensated care. So in those situations, one could make a pretty good argument that, why would I need to go through this S-10 audit, because I'm not really going to be paid any uncompensated care because my hospital-specific rate is already considerably higher. That argument came up in the fiscal year 21 final rule, proposed rule versus final rule, or started in the proposed rule, then public comment into the final rule. And basically the commenter requested clarification regarding whether these SCHs are subject to these audits. And they said, they talked about reducing provider burden. They're not really truly eligible for incremental DISH payments, because they're not going to get paid specifically for DISH. So there was some discussion there. And if we go to the next slide, we'll see CMS's response was that all hospitals are required to maintain documentation for cost reporting, including worksheet S-10. And at the very end, after consideration of the comments, they're finalizing without modification their proposal to use the S-10 data from the 2017 cost reports. So if you read through that whole thing, I skipped over a little bit for length, but it basically is saying that, yes, the Soul Community Hospitals are still subject to the S-10 audits. And I know, again, a lot of providers have commented on that or questioned on that, but we are required by CMS to audit that data. So the information requests did go out to the Soul Community Hospitals as well. Now, there are a few provider types that are excluded. Again, it's DISH eligible. So certainly if it's a critical access hospital, they're not in any way, shape, or form DISH eligible. So if you have an acute care hospital that has converted to critical access hospital, that's basically deemed to be a termination of that original acute care provider number. And those providers that have termed, including the termination or transfer to a critical access hospital, they are excluded from the S-10 audits, because there's just no way at all the data could ever matter for those types of facilities. For the Soul Community Hospital, if you go back to that response, CMS's response was that things can change. A Soul Community Hospital, possibly the hospital-specific rate could be lower at some point than the federal rate, And they go through just a variety of other things. They could lose eligibility for other reasons. So for all those reasons, they said sole community hospitals are still subject to it, but terminated providers that are not going to be in existence by the time these rates take effect, and those that converted to critical access hospital, they're not going to be part of the S-10 audits. Now, occasionally we'll find a hospital that was sent an information request letter, but again, now they've terminated, so we do discontinue the audit at that point once we find that out. On that note, though, I do want to mention there is one interesting thing about the worksheet. Yes, I'm going to try to mute everybody again. I don't know what's going on here. Okay, the S-10 in cost reporting instructions. Interestingly, at the very end of them, if you look at the cost reporting instructions in HFS or on the CMS website, it says that Section 1886D hospitals and cause are required to complete this worksheet. Now, the only reason critical access hospitals ever had to complete the worksheet was for the EHR incentive payment. However, it appears that CMS just maybe hasn't updated these cost reporting instructions yet. Or maybe they have some other reason they still want that data. But when we get asked the question, hey, does a CAW really have to complete it? The only answer we can really provide is that yes, the cost reporting instructions still say you're required to complete it. Whether or not CMS is going to really use it for something, we don't know. But again, until CMS updates the cost reporting instructions, that's kind of the answer we're stuck with at this point. So we are making a proposal to them. There are some revisions, some major revisions to the cost reporting instructions in draft right now. So we're going to see if they can change that, unless they really have a purpose for that data. So going on here, we have just an overview again. The S-10 in the past was used for the EHR or high-tech incentive payment. It's no longer relevant at that point. We're a few years removed from that. But what we're concerned with it now for is factor 3 of the DISH uncompensated care payment. Now, this S-10 for every individual hospital is going to be used to determine that hospital's percentage of the total national uncompensated care, that DISH uncompensated care payment. It's referred to as factor 3. And if you take a look at that, the USCP factor 1 is just the national pool of DISH uncompensated care available, if you will. It's 75% of the DISH payments. The other 25% providers are still being reimbursed actual DISH. And UCP factor 2 is a reduction factor due to expected decrease in the number of uninsured patients. This changes each year. And then we're with factor 3. That's the one we're mainly concerned with. That's the hospital-specific share that we're going to be calculating through these audits. And yeah, Eric, we have a good question there. Is WPS going to audit critical access hospital data? The S-10 data, not at this point. There is no protocol for us to audit that. But again, that might change in the future. We did audit it with the EHR audits years ago, but there's nothing for the S-10 audits at this point that, and we haven't requested it from anybody as well. So yeah, no audits on CAW data right now, but again, things could change depending on what CMS asks us to do. So good question there. So factor 3 is what we're concerned with. And basically it's going to be calculated by taking, CMS will calculate it and they'll publish it in the final rule. They'll take a look at all of the hospital's S-10 data, line 30 specifically, and they'll pool it together and then percent to total. Each individual provider, whatever their percent of that total amount is, that's their factor 3. Here I just wanted to show the Federal Register, the latest Federal Register where this came out. This is factor 1. The way this chart looks, they're actually showing the estimated DISH payments in total. So the factor 1 is going to be the 75% of this total DISH amount. And then factor 2, again, is published each year in the Federal Register. That's that reduction factor. They go through a lengthy discussion of why they believe that's proper. And with that, I'm going to turn it over to Ron Wolf to talk about some lessons that have been learned from the prior S-10 audits.
Yeah, thanks, Chris. And just to let you know, I think there's just a slight delay in the slides advancing, just to give you a heads up. It's just like a second or two. But yeah, as Chris mentioned, I mean, we thought it would be a good idea to share some of the feedback with you to let you know, first of all, that we are listening and we continue to listen, but also because it provides some context for the rest of the training material that we'll cover today. And these next couple of slides that we have are just some of the common themes that have been identified from the most recent round of S-10 audits. And it really reflects, it's kind of a comprehensive reflection of feedback from a variety of stakeholders that includes, you know, WPS staff, other MACs, providers, consultants, health lawyers. Now, one of our goals is kind of continuous process improvement, and a key to achieving this is seeking and obtaining continuous feedback. And we feel at WPS we've, you know, implemented a rather robust process to include things like, you know, throughout the audit cycle, we have regular internal S-10 feedback calls with our supervisors. We also get feedback from providers and their representatives through, you know, audit interactions, separate calls, and also feedback to a new WPS feedback email that we'll talk about here in a second. And, you know, at the end of the year, we also, you know, provide an opportunity to solicit feedback from all of those sources too. But then interwoven with all of this throughout the year, we've got an S-10 MAC work group that we've been participating on. And then we've got regular calls with CMS and Myers and Stauffer throughout the cycle, which, you know, in the heart of the audit cycle, we're meeting as frequently as, you know, a biweekly basis, probably from about June through the end of the year, just to, you know, have these issues, all these sources and calls kind of serve as a way to funnel ideas and issues up the ladder that, you know, number one, it's like we're going to try and identify things that can be addressed real time, always with the goal of consistency in mind. But, you know, not all issues can be resolved without involving the policy folks at CMS. But there's other opportunities through notice and comment periods for the rulemaking. And also, as you know, we more recently have been involved with that Paperwork Reduction Act notice. But there are some other mechanisms in place for the MACs to submit questions to the policy folks throughout the cycle too. It's just sometimes it can take a little time to actually get some answers back on those types of questions. So as we look at some of these themes, I thought it would also be helpful to consider, you know, a couple of things to be aware of are that there is a difference between, you know, the data that's requested through these templates, and that's all at the transaction level, but that, you know, we're also auditing some of the detailed support at an account level. So it's just something to keep in mind. I think some of the providers that have been through this cycle here for a few years now are aware of that and addressed, you know, some confusion at the outset. But for the majority of the hospitals that are just in year two of this process, that's something to keep in mind. You know, if you're getting questions from auditors, just kind of keep that in mind. It might help resolve some issues early on. And then also, I think it helps if you kind of think of these S-10 audits as kind of a two-phase exercise. Phase one being the data analysis phase, and then phase two is really more the detailed sampling testing phase. And I highlight that because, you know, number one, out of all of the feedback that we got, the biggest issue identified without a doubt was the format of the listings, and that includes, providers questioning the number of requested data fields. And we do too in certain respects, things like, hey, are these revenue codes really necessary, given the difficulty of polling, and the fact that, they could be identified through the testing piece. And then there's some other demographic fields. A lot of listings we encounter involve missing data elements, and that all requires us to follow up, sometimes multiple times to try to get this data. And, that really just kind of eats up some of that advantage of starting early, because timeline has been a kind of another recurring theme that we'll get to. But one thing to keep in mind, so as part of this, front-end data analysis phase, the goal really here is really kind of understanding your process, and that's really, the way the confluence of like your policies, the query logic that's requested, transaction codes. That's really to give us an idea of how this data is pulled together, how they relate to one another, and with the goal of identifying potentially erroneous populations up front. And then that will help limit the use of extrapolated error rates. So it's really about carving out things that we think are incorrect. With respect to query logic in particular, which Chris will talk about probably in a little more detail later on, one of the issues that we encounter is taking that term query logic literally. And so I know a lot of you reimbursement and finance folks have to work with your IT team in order to pull a lot of this information. From the IT people's perspective, they hear query logic, they think, oh, they want our scripts, and that's literally what we'll receive. So that really isn't a much benefit to, the auditors that are working on this. So wanted to point that out, that, maybe when you're speaking with your folks to make sure they understand, it's really the business requirements or pseudocode. Those are terms they're more familiar with. It's really just a narrative of how they're pulling this information together. But like I said, we've got, some responses to those problems that we've implemented towards the end of last year, but really will have available to us at the outset for this next round. As far as timeline obstacles are concerned, and before I get to the timeline obstacles, I just wanted to stress, because the importance of furnishing as complete a data set as we can at the outset for those things that I mentioned, because ultimately there's a reason why CMS has, included those in the template. And for any of those pieces that are missing, that represents some additional risk from our perspective. And then we're charged with, mitigating that risk, and some of the, obvious tools at our disposal to do that are, expanded samples, extrapolation, et cetera. But that requires a lot more time and effort for everyone. So, getting these things right on the front end will go a long way in streamlining this process, making it easier for you, for the auditors, and, more importantly, helping us identify some of those, populations that might be in error that we can carve out then before we ever get to that sampling phase. So I just wanted to reiterate that point. But then as far as timeline obstacles, for all of these reasons, everyone's, I think, advocated for, based on the comments to the most recent rulemakings, hey, we need more runway to work with. We've got this overlapping with the wage index review process. There's a lot of 630 providers. They got to file their cost reports during this time period. So whatever additional time you can provide, the better. And that's really what we've been, commenting on ourselves as part of the, rulemaking process, because it really helps preserve the advantage of that early start. It's so dependent upon, getting good data at the outset. And, one of the other things that's been mentioned as well, we can extend the back end of this timeline too by utilizing, different HICRA states. But those things, as we've discussed these issues with CMS, some of those things are locked in as part of, regulation, as part of the statute, as part of that rulemaking process. So it's not as though they don't have the ability to move some things if there's a great justification for. So we've been advocating, hey, why not use the March HICRAS for the proposed rule, because that doesn't come out until April or May every year. And then the June as the final, since that's more of an August, September final rule exercise, with the hope that we could get some things resolved if there were some, problems with audit findings, et cetera. And really the last three rulemakings have had something come up where CMS has taken advantage of that. But, based on what they've published most recently, other conversations we've had, I mean, they're pretty committed to sticking to that unless there's something like COVID or a series of hurricanes, et cetera, that would cause a lot of issues for a big section of providers. So just some things to keep in mind, be aware of. It looks like we've got another question that popped up here, Chris. So what I'm hearing is that while the templates are optional at this time, or thought I read somewhere, that's correct, it's in our best interest to try to provide the data elements that are in the templates. I would say emphatically, Susan, great question. Yes, that's the message we're trying to convey. I get it. It's difficult, but I'm sure everyone's aware there are some things in the works through this most recent PRA where they're trying to standardize some templates as part of the cost report filing process. And, whether a cost report will be acceptable, depends on, a dish listing, a bad debt listing, some S-10 information. But in terms of these audits and trying to make the process go smoother and really allow, some automation to be done on both sides, it is really critical to the extent you can to try to get us as much of that information as possible. So great question. We could probably move on to the next slide, Chris. Just a couple of other themes that we wanted to mention. This first one being a rather obvious one. We've been hearing about this from the outset of these audits, inconsistent sampling among the MACs, sample sizes, extrapolation methodology, even the types of documentation that are requested and reviewed. We have made all of this feedback. They're well aware of it. The policy folks see the comments to the rulemaking. We reiterate these things ourselves in our, end of year sessions with CMS and Myers, and we're trying to brainstorm on ways we can make that process better and bring some consistency to bear. And there's some other things that are being considered for future periods too that might hopefully someday allow us to take some more of a risk-based approach and potentially scope things depending on what the data looks like over a 1 or 2 year period. More to come on that hopefully with the next rulemaking. But another surprising one is communication breakdowns, because this seems like such an easy thing to avoid and remedy. And we try to make great strides, and I think we have at WPS with respect to, identifying the proper points of contact up front, who your auditor, who the supervisor is going to be, and really confirming that information during the entrance conferences. You know, for a lot of our chain providers, we select a lead supervisor to serve in that role to coordinate that entrance conference, but also to kind of disseminate information that bubbles up throughout the audit process, so we can share that among the different auditors that are working on that particular chain. You know, but these are some pieces of feedback that I heard from some consultants and providers that deal with more than just one MAC. So apparently there's still some issues out there, but we try to share, you know, best practices on those MAC work group calls to try to help avoid or remedy some of these situations too. But, you know, if you're running into problems like that, please feel free to reach out, because those are things that we do discuss as a group and try to find effective ways to mitigate it before it becomes a real problem. And then this last one, and granted, COVID this past year was a unique situation because of, you know, the time constraints it created. You know, they put a pause on things, but then, you know, re-implemented. We were auditing all dish hospitals, so we had a much larger volume of providers to get done, you know, by the end of the year. But with respect to reviewing and responding, all providers should have 2 weeks, you know, 10 business days to review those things. And again, if you're running into problems with that, please bring it to our attention, because we will raise it, you know, with that MAC work group, with the CMS, you know, we'll take it to the top to get those things remedied. It looks like we got another question that popped up here. So another issue is inconsistency in methodology and how findings are reported adjusted on the cost report between auditors at the same MAC. We had one WPS auditor flatly refuse to make the necessary adjustment on our S-10, while another one made the corrections without any issues. You need to make sure that all of your auditors are being consistent in the process. Great feedback. And again, if you encounter situations like that, please don't hesitate to reach out to myself or Chris. And then we've also got like a feedback email address that's we'll talk about here in a second on our webpage that you can also utilize. You can call me, you can send me an email, and we will. We're trying to correct those things for sure. So appreciate the feedback. Last theme here that I wanted to talk about were, you know, education and training opportunities. A lot of times this is brought up during the exit conference. And one of the things that, you know, we had brought up frequently is, hey, you know, knowing what types of errors and issues are coming up around the country would be helpful, you know, to providers. So that way, you know, we can kind of tailor some training around that. Certainly, you know, put more of a focus on those pieces to avoid those types of adjustments and errors in the future. So we have shared that information with CMS and Myers, and hoping that, because they do reviews of all of the MAC's audit work each year, and, you know, seeing if there isn't a way that we can communicate some of that information, you know, to hospitals for that purpose. So it looks like we have another follow-up question here. Are you saying that there will be preliminary period for revisions to be made prior to sampling? Do you know if other auditing firms' MACs have been instructed to extrapolate? We noticed that some auditing firms did and some did not extrapolate. Are differences in interpretation of financial assistance policy subject to extrapolation? So, Chris, I know we're going to get into some of these areas in more detail. Do we want to wait until you have a chance to cover these in those sections?
Well, I think we could prelude it right now, or yeah, we can talk about it now as well. So the number two, we'll talk about the extrapolation. I will state, I know we can't really share the audit program itself, but I think it's safe to say that basically statistical sampling is an absolute requirement at this point. Uh, and that's part of statistical sampling is extrapolation. Now, in a perfect world, we'd be able to get all those errors cleaned up on the listing before we even get to uh, detailed testing and therefore extrapolation. And what we mean by that is that if you have very obvious errors that, like, for example, they're written off in the wrong period, those should be self disallowed before even submitting the listing to avoid any sort of error rate that gets extrapolated to the rest of the population. So that's really the only way to avoid extrapolation is to find another way to clean up the errors and basically be able to obviously identify what those errors are. But the biggest problem is once we get into a sample, if we get into a statistically valid sample and we find those errors haven't already been cleaned up, that's when we're stuck with extrapolation. So what I can say is that all Macs should be doing, whether it's a consulting firm or another Mac or whoever, they should be indeed doing statistically valid sampling. That is a CMS requirement. Um, Now, I'm not sure about number three. Are differences in interpretation of financial assistance policies subject to extrapolation? So I guess it gets down to if that most of the time that'd be that claim is or is not allowed. That's where the financial assistance policy would come into play. So if that was determined by the auditor to not be an allowable claim, for example, your policy said you don't allow something, but then you're trying to allow it, in that situation, it would indeed be an error and therefore it would be extrapolated. Since it's a statistically valid sample, the thought is that within sampling risk, if that error exists in this sample that might, I'm overly simplifying this, but if this sample was 10% of your population and this one error existed, then it makes sense that that error is also going to exist in the same percentage in the entire population. Again, that's a huge oversimplification of it, but that's the basis of statistically valid sampling. So I guess the short answer to number three is that yes, that could indeed be subject to extrapolation. And number one, so the preliminary period for revisions. So the goal here is if we can get the cleanest listing possible up front, that's kind of what we need. And really, that's what we built that query logic questionnaire for. If a provider goes through that questionnaire, that should clear up a lot of the confusion about what we really need this listing to look like. So if somebody completes that, hopefully the listing that comes out is free of those obvious errors that could otherwise be cleared up. And the only errors that are going to be left, of course, would be detail testing type errors. So no, there won't be another period after that for revisions, if that's what you're saying. Like if we've already requested a sample, basically at that point, once we've requested a sample, we're locked into it. If we start doing that detailed work, we're not going to be able to request a completely new sample a second time or a third time. So hopefully that helps to answer that question there. But yeah, we will definitely touch on sampling a little bit later on as well.
Chris, I think I understand where they're coming from because short answer, CMS Myers are aware that there are some contractors out there, probably subcontractors that have been taking a different approach, and that's created a lot of confusion and issues around consistency. And I think in those instances, they take kind of a small probe sample of a few claims to identify big error populations, and then give providers a chance to come up with a new listing. And based on our discussions with the other Macs and with CMS at the end of the year, they're aware of it. I think they're going to address those types of things, on a go forward basis. but and that's kind of what I was trying to allude to, that they're aware of the situation and some of the reasons behind some of this inconsistency. But yeah, that's why we're trying to place the most emphasis on getting these things correct on the front end, because once we start moving through the audit program and moving out of phase one into that second phase of testing and sampling, you know, it's at that point it's real difficult to try to restart things. And then I would add to Chris, with respect to number 2, not number 2, but number 3, you do have a section where we're going to talk about the importance of the financial assistance policy language. I mean, we kind of recognized some issues with the, you know, requirements around how detailed the language needs to be. So we'll wait and cover that when you get to that part, Chris. But we were cognizant of the fact that, you know, a lot of hospitals are going through this process for the first time, and you know, we decided to send out communication to that effect that, hey, be mindful of these things with respect to your financial assistance policies. But he'll cover those in a little more detail. Okay, so we got one other question here, Chris, real quick. You can probably advance the slides and let everybody see kind of our new email address, which is out there on our web for providing feedback, not just for S-10, but for any audit issues. So definitely interested in hearing people's thoughts and addressing things as early in the audit process as we can. So this other question that came up says, using your write-off in the wrong year, what if the provider looked at 100% of those errors in the list and provided that amount to the auditor? Would that be an alternative to extrapolation, as the purpose of extrapolating is to estimate that error to the entire population? Chris, do you want to address that one now, or wait till we get to that piece?
Oh, yeah, I'll go and address that one now. So the only problem with that is, first of all, the query logic questionnaire should eliminate that type of issue. If the provider goes through, that's one of the questions. Did you write it off in the proper year? So hopefully we wouldn't come across that. But I guess the problem with doing what you're proposing is that we've already done the statistically valid sample. We've probably already started testing. We probably have tested by the time we've given you the errors. So a lot of work has already been done at that point. A lot of time has been used up. We're getting closer and closer to the end date for those. So if we were to return that, it would be completely restarting the audit at that point. So that's the one issue. The second issue is there are other things that could be in the same bucket, so to speak, that could be pervasive throughout the population, other than just this whole written off in the wrong year. For example, let's say we did what you were suggesting and we allowed a brand new listing to be submitted. Then let's say then in the next sample, we'd have to redo another sample. And now all of a sudden we find a completely different error, like the inclusion of improper revenue codes, professional services. So you could see where that could keep dragging out, and we'd never be done with this audit after 12/31. So because of that, what we essentially do, statistically valid sampling allows us to extrapolate and project the impact of that error on the population. So that would be what we'd be doing in that situation. We'd be using extrapolation. But again, it's all about getting the listing as clean as possible up front before we start even doing the sample selection. And that was the main intent of that query logic, which when we go through that, I think you'll be able to see what I'm talking about there. So hopefully we don't run into those situations by that time where we've already done a sample and now these other pervasive errors are popping up. So good question, though. And let's see, we have another question here. If there are older claims written off in which the hospital cannot accumulate all of the required information, Is it possible to include those claims in the listing with the understanding that they would be under more scrutiny from a sample selection standpoint? Let's see. So you're saying on the listing itself, you don't have all the required information. So the problem there
Chris,
is, oh
I,
yeah.
I think it's more supporting documentation for older claims.
Oh, so, okay. So you have the
Well,
information.
it could actually, now that I'm reading it, it could be either you don't have enough information in the for the listing, but then maybe not all of the supporting documentation too, or maybe Jesse can clarify that a little bit for us.
Yeah, now while we're waiting for that response, I do want to go back to Tom's question again also to note that when we're looking at that listing, we do some pre-work on the listing. So if we can obviously determine that they're in the wrong period, chances are those will be written off, or those will be separated out before we even get to the extrapolation, before we even get to a statistically valid sample. So no, we're not going to leave errors that we can very obviously identify. We're not going to necessarily leave those in the overall population and then intentionally extrapolate them like that. It's only if we find if there's something that, so let's say it showed that it was written off in this year, but when we get down to the detailed testing, we find that no, it was actually written off in a prior year or the next year. That's the type of error that we're talking about at that point. Not so much the obvious errors that we can quickly carve out up front. So maybe that'll help to clarify that piece a little bit more. But Jesse, let's see, the information is available if the patient claim is viewed from an account detail. Oh, but it can't be exported on a batch basis. So yeah, it would be the listing itself that's missing the information. So that gets a little tricky because that kind of going back to the answer I just gave to Tom's question. When we see obvious errors up front, uh, chances are those could be carved out just due to missing information before we even get to detailed testing. So I don't know, Ron, do you have any more to add to that piece now that we have that clarification for that question?
I think you probably answered it correctly, Chris. I mean, I suppose, yeah, if we're identifying, a population that we're aware of it, and can be carved out from the listing. I think the question is, hey, can you still test those kind of separately and potentially include them, even though we don't have all of the information included in the listing? I think that's where they're coming from, Chris.
Yeah, and the biggest problem is we wouldn't be able to do a whole lot of upfront analysis because when we're looking at those listings, before we even get to the detailed sampling, like Ron alluded to earlier, we have quite a bit of work that's done up front, and we do the analysis. For example, we're checking for duplicates, we're checking for some obvious illogical things, where maybe the charity care that was written off is more than the charges ever were, so that doesn't make sense. Or maybe if there's a charity care and a bad debt, the sum of the two exceed the charges. That also doesn't make sense. So things like that. And when we're missing a lot of information from the listing, we no longer have the ability to do that. So that's where a lot of that carve out is going to be taking place up front. Uh, because otherwise, in a worst case scenario, if a provider gave us a listing that was missing a couple of data elements for every single provider, or I'm sorry, every single patient, or most of them, we'd at that point be to the point where we'd probably have to test even more than just our standard sample. So if it's missing that information, it's most likely going to be carved out. That's the short answer there.
All right, Chris, I think we can move on.
Okay. And let's see. So yeah, there's one last question there about the missing demographic information. So if you have that information, you can tell us that, hey, your IT area does not allow to pull SSN. That itself, as long as we have something else, another patient number, the name gets a little bit tricky as far as checking for duplicates because little small differences in the name may elude the duplicate check, if you will. So if you have another patient number that you can use at least temporarily in lieu of the SSN, that might be allowable in that situation. CMS hasn't said, hey, you can remove it completely from the listing across the board, but we might be able to deal with situations like that since the SSN itself isn't really has nothing to do with the payment, the amounts or anything like that, the eligibility for that claim, if you will. So we may be able to work with you on that, and that'd be a case-by-case scenario, just depending on your IT system. So that's a good question as well. And yeah, it looks like this slide, this actually should have been back when we were talking about factor one. I must have misplaced it, but this just shows what the factor two was for this year, 72.82%. Remember, that's that reduction. So that 75% of the dish payments, that's being reduced down to 72.82% for this fiscal year. And here this shows what the actual pool is, 8.2 billion. And factor three is each hospital's share of that pool. That's the purpose of our S-10 audits. Now we're heading into the next section, which I said we'll probably spend maybe even the majority of the time in this section just talking about the details of what each line means, what we're looking for. So just to reset where we are, the cost reporting instructions that we're following for this year's audits are the same that they've been for the past couple of years, which is good because there's no worry about understanding new instructions at this point. Those current instructions have been in place since cost report periods beginning on or after 10/1/16, and again we're 10/1/18, or I'm sorry, 10/1/19 here. No, 10/1/18 through 9/30/19. So we're a few years after that, a couple years after that. Now the instructions themselves, when they did change, they impacted the line 20. Well, 22 is charity care cost. 20 is where you report the charity care. Now this is off completely. 20 and 22 is what this should be. 20 charity care and 22 payments. But it did not impact line 26, which are bad debts. I do want to mention here, we're not going to get into it in too much detail to avoid confusion, but there are other changes that are in draft basically at this point for federal fiscal years beginning on or after 10/1/20. I'll just mention a couple pieces of it when we get to those lines, but they're all pending the public comment, the final rules, and all of that. So more to come on that later. It certainly won't affect this year's audit by any means. In fact, as you can see, it won't affect the audits for another couple of years at least. So this is just a screenshot of the cost reporting instructions out of the cost report software, just to point out the fact that the line 20 has two different sections. The ones before 10/1/16, which has no applicability to what we're doing right now, and then all of the information beginning on or after 10/1/16. That's what we're concerned with. Now, as far as the line 30, I said that's the element that's going to be used by CMS to calculate the factor three. That line 30 is comprised of two main sections. Line 23, which is charity care, that's the actual cost of charity care, plus the line 29 bad debts. Now, again, 23 is after we've already audited line 20 and 22. 23 is the result of that. It's the net amount of that. And line 29, even though the bad debts are entered on line 26, there are some calculations that we'll talk about later that allow it to flow down to line 29 as an actual cost of bad debts. So these are the two elements that you tend to focus on. Neither of them are input numbers, but they're still important kind of subtotals, if you want to call them that, products in some cases. Going in a little bit deeper here, focusing specifically on that line 23, that charity care cost. The way this works is the actual charity care charges or co-insurance deductible amounts are reported on line 20 right here. Now that includes charity care and uninsured discounts. Now again, we have two columns, uninsured patients and insured patients, columns 1 and 2. So the charge itself is reported there. And then you'll notice that line 21 reduces at least some of that down to a cost. And this goes back to line 1 of S-10, which is the cost to charge ratio. That's how it gets reduced down to a cost. It gets multiplied by that cost to charge ratio. So for example, these uninsured patients, you had nearly $2 million of charges. That was reduced down to $684,000 of actual cost. But notice in column 2, the uninsured or the insured patients, which again, this is a co-insurance deductible or now even a co-pay number for the most part. Those amounts, co-insurance deductible and co-pay, are not subject to a cost to charge ratio reduction. So that's why this number is the same for the insured patient column. However, the way the current cost reporting instructions are, they have a little bit of an odd element to them where there are some things included in column 2 that aren't necessarily co-insurance deductible or copay. Specifically, it's a Medicaid patient that has exceeded the length of stay limit, and therefore you could argue they're not, for that portion of the claim, really eligible for Medicaid anymore. There's no co-insurance deductible or anything like that. So it's a charge amount for that last part of the claim. That charge amount gets commingled with all the other co-insurance and deductible amounts in column 2. But since it's an actual charge amount, that piece is subject to the cost to charge ratio reduction. So we'll see that later. That's actually down on line 24 and 25. But in that situation, line 20 and 21 won't necessarily be the same for this column 2. But in other situations, they will be identical, and that's fine. That's all built into the cost reporting software. There's nothing you really need to do about that. And you can see line 22, which we'll get to in a bit. That's any payments that have been received from patients that year for amounts that were previously, and that's a keyword, previously written off as charity care. So we're going to touch on this in a couple of different places, but again, this amount reduces the amount that was in line 21. So in other words, for example, we've determined that you had $684,000 of uninsured patient cost. However, you have some payments, $33,000 of payments that were made. So CMS is not going to treat that as uncompensated care because it was obviously compensated. That's why that reduces the amount that goes to line 23. But the point I want to make to this, line 22, is that these are not current year payments, or I'm sorry, these are not payments against current year charity care. They're payments that were received this year as almost recoveries of prior year charity care. That's basically what line 22 is. It's kind of a recovery type thing, similar to a bad debt recovery. And again, we're going to touch on this later on, so I don't want to deviate too much yet, but that's what line 22 is about. Then when we get to line 26, there's only one column for this at this point, but the point I want to stress here is that line 26 is total bad debt expense, Medicare and non-Medicare. But they both have to be net of any recoveries. If you've recovered the funds for those bad debts, they're no longer bad debts, so they don't belong in line 26. So a couple of key words here. Total, first of all, again, Medicare, non-Medicare. And it currently includes the phrase bad debt expense. And what that, if you look at the instructions, we're talking about those that were written off of the general ledger and your financial statements this period. The point I want to stress here is that this is solely related to your financial statements, your financial accounting records, not just Medicare and not even just what was reported on the Medicare settlement worksheets like E-Part A or E-Part B. So what I'm saying here, and we've talked with CMS and other MACs about this too, to make sure everybody's on the same page. These are those that were written off of your general ledger this period, even if that has not been allowable for Medicare yet. In other words, you wrote it off. It's a Medicare bad debt that you've written off on your financial statements and general ledger, but maybe it's at the collection agency, and Medicare policies do not allow that to be allowed for Medicare yet. Even though it was written off, it's not Medicare eligible at this point or Medicare allowable. That might come next year or the year after that. That's fine. We want to see that bad debt in line 26 when it's written off of your general ledger. And then later on, the Medicare portion will be handled. Now, Medicare bad debts also, and I have that underlined on purpose intentionally, they're also flow into lines 27 and 27.01. You don't input anything there. Whatever you have on E-Part A or E-Part B or any of those flows into line 27. Well, first line 27.01, they've got these two lines kind of reversed. 27.01, these are the allowable bad debts. So it's the total amount you've reported on all those settlement worksheets. And then line 27 is the reimbursable portion. So after the reduction, if you will, after the reduction down to 65%. So line 27 is 65% of 27.01. That's the Medicare reimbursable amount. Now, of course, that would only be those bad debts that were allowable for Medicare at that point. So returned from the collection agency and everything. Line 28, we get the non-Medicare bad debt expense. And what the way that's calculated is just taking 26, which was total, and it subtracts out the Medicare portion to determine what was non-Medicare portion. The reason this is important is that line 28 is subject to the cost to charge ratio as well. The thought is that these are not necessarily co-insurance and deductible amounts, whereas we know Medicare bad debts have to be co-insurance and deductible. So line 28 are those that are not, and therefore they're going to be subject to the cost to charge ratio reduction. And then down in line 29, that reduced amount is added in to the other 35% of the Medicare bad debts that were not reimbursed. So we're going to add them in as uncompensated care. So that's how that part works. I do want to mention one other thing here. I stressed the word expense up in line 26. Now, in previous YouTube videos and even training courses, we've talked about how GAAP itself, generally accepted accounting principles, have changed in recent years, and they're actually still changing. There was an extension for nonprofit facilities, nonprofit hospitals or entities, but GAAP is going away from an expense recognition altogether, and instead they're using basically a contra revenue recognition, a direct offset to revenue for bad debts. They call it the implicit revenue or implicit
Price concession.
Yeah, price concession. That's the term I'm thinking of. So that word expense is probably going to be expunged from I'm pretty sure it will be from the cost reporting instructions in the near future, but right now it still exists. So we're not so concerned for this audit. We're not looking at where it was written off. Was it written off to contra revenue or actual expense? So don't really pay too much attention to that word, if you will.
Hey, Chris, we had
a
question coming.
Yeah, I see those, and that very good question, Shannon. Bad debt on the financials. So excellent point. We under GAAP currently, or under the old method for GAAP, where you did write it off as an expense, the bad debt expense was an estimate, and then the actual write-off, you never actually see a write-off on any financial statements. So you'd only see the expense and you'd see the allowance account. So that's part of the reconciliation, which actually comes up in the next couple of slides. One of the things we look for in the initial submission is a reconciliation of the amounts that you can see on the financial statements, which would either be you have accounts receivable, you have bad debt expense, and you have the allowance for doubtful accounts. You see those three, and we need a reconciliation between really any of those three numbers and how you arrived at true write-offs. So we'll talk about that example in a little bit. But to answer your question, no, you would not want to show the reserve or the allowance account. We actually need to see just the true write-offs, which is a derived number from the financial statements. You can only derive it. It's an implied number, if you will, or imputed. So again, we'll get to that in just a bit. And let's see. The last question here, while very rare, how does a hospital report bad debts on line 26, where the net bad debt for the reporting period is a reversal of bad debt due to the hospital reprocessing previously written off bad debts for charity care eligibility? This typically prompts a level error since line 26 can't be less than 0. So that's an excellent point. If you get to that situation where you're reprocessing so many of those bad debts that it offsets all of the positive bad debts, there's actually no real way on the cost report to handle that at this point because of the level 1 error. I don't know that we've come across it where it's completely offsetting current year bad debts. We might have to work on that situation if we come up with it. Yeah, there's no good answer for it. I see where you're coming from, how there could be some reverse like that. We've just never seen 100% or more than 100% of the current year bad debts offset. So we'll have to deal with that. We might even have to work with CMS to find out how to handle that. What if we can use a plugged figure somewhere? That would get kind of messy because then you have to go through all the calculations yourself, but could be possible. And so another question about Medicare bad debt. Medicare bad debt has a separate CMS template and a separate Medicare audit, but we were receiving requests to revise the listings to be put into the S-10 template format. So it's necessary because we're auditing different things with the S-10 than we would necessarily with Medicare bad debt. But the other piece of that is that in the past, we've had some providers that just gave us a listing of non-Medicare bad debt. And then they said, hey, go ahead and add in our Medicare bad debt from the listing we submitted at the time of the cost report submission. That definitely won't work. First of all, again, due to the data elements, but second of all, due to the potential timing differences that I mentioned earlier with the collection agency. That's your main example of when there could be a difference in when something's reported for line 26 versus E Part A, for example. So yeah, the answer there is that we would need those to be submitted separately. Just for one example, one of the things we're looking for separately is where that bad debt came from, what type of service is related to. That's not something we look at on the listing for Medicare audits, for the Medicare cost report audit, but we do for the S-10 audit because we have to carve out physician and professional services with the by revenue code. We have to do that review. And this is a great question. Do we include non-patient or insurance company bad debt on line 26? And the answer is definitely no. This is only patient bad debt or uncompensated patient amounts. So if you have an actual insurance company, and I think when we get to the cost reporting instructions, it has a clause in there specifically stating that this does not include that or something to that effect, but it definitely should not include the insurance company or anybody else's bad debt. Good question, though. Okay, it looks like we're at a good point to continue on here. Actually, I already went through this piece. This is just a continuation of where we were earlier. how we get to that line 29 ultimately. And now we're going to move on to some more cost reporting instructions in a little bit more detail. So for column 1, we're dealing with uninsured charity care charges. And this is the little excerpt of the cost reporting instructions for that. So enter in column 1 the total charges or even portion of total charges if you don't write off the 100% of that claim that were written off to charity care for uninsured patients and patients with coverage from an entity that does not have a contractual relationship with that provider. But notice this little statement, who meets the hospital's charity care policy or financial assistance policy. You'll see that phrase repeated several times. Basically, your policy has to allow it for Medicare to allow it. Medicare doesn't put any more stringent criteria, but they do say your policy needs to address it and needs to allow it. In addition, enter in column 1 charges for non-covered services, so keyword non-covered, provided to patients eligible for Medicaid or other indigent care programs if such inclusion is specified in your charity care policy and the patient meets your policy. The total charges or the portion of the total charges is, again, whatever charity care you've approved. If you give them 100% discount or if you give them 70% discount, whatever you've approved. So that's column 1. Again, key thing is that it has to be in your policy. And if there's I want to stress this part, the non-covered services, you could have one claim where part of the services were covered and part of the services weren't. In that situation, only the charges related to the non-covered services would be in column 1, and the other services that were covered, those would be in column 2 as deductible or co-insurance, whatever. The non-covered services are going to be just charges. That's all that exists there. So again, uninsured, and really we stress these last two pieces as well. However, the charges that are non-covered due to those patients exceeding a Medicaid length of stay limit go in column 2 instead. Now, one could argue, hey, isn't that just a non-covered Medicaid service, just like we talked about? And my answer would be, yeah, it's extremely similar, but for whatever reason, and we've never really gotten a good response from CMS on why it needs to be separated, why they use this data separately, but CMS currently asks for those specific issues with the Medicaid length of stay limit. They want those separated out in column 2, and that also goes into that kind of tricky line 25 that we'll cover in just a bit. The key thing here is that these are only the portion written off to charity care during this cost reporting period, and this was different from the old instructions. It's write-off date that matters now. It used to be service date. The other thing is that you should not have courtesy discounts included here. Now, that's separate from an uninsured or self-pay discount. Those are allowable, but courtesy discounts are not allowable. Those are usually for certain classifications of patients, like, for example, sometimes they're given to clergy, maybe family members of hospital employees, just a variety of that have nothing to do with financial status or anything like that. No financial assistance needs. Those are not allowable. Also, anything related to physician or professional services, those are not allowable. Self-pay or uninsured discounts are allowable as long as they're specified in your charity care policy, as we said before. Let's see, moving on to, another point about the uninsured charity care charges. If a payment was made in the same year as that write-off, so for example, you wrote a claim off for charity care January 10th, and then a few months later in the same year, the patient, even though they had been approved for charity care, for whatever reason, the patient or their family or whoever came in and paid that money on their behalf, which I know we've been hearing from some hospitals that they have a policy to return those payments. And if you return it, then it's not a payment anymore. But if you have a payment that still stands and it was made in the same year as that charity care write-off, it's considered to, nets itself out basically. But CMS does not want to see either the charge in line 20 or the payment in line 22 in that situation. They're only oh yeah, that's the key thing I want to point out here. That payment that we're talking about, we're only talking about payment against an actual charity care amount. If that patient owed money, they were only given a 75% charity care allowance and they owed the other 25%, then of course the payment toward that 25%, that's just a valid payment. We don't need to see that anywhere. That's paying their non-charity care amount. We're talking about any payment against this actual charity care amount. And we'll stress that a little bit later as well. The other thing, some claims have both a covered portion and a non-covered portion, just like we talked about with Medicaid a bit ago. Maybe there were exhausted benefits for some other reason. The non-covered charge portion goes in column 1 as uninsured, but the covered portion, which is coinsurance or deductible, goes in column 2 as insured. Now, the biggest thing here is that, of course, if we just do a simple duplicate check, it's going to pop up because this same date of service and patient showed up in 2 listings. So we'll be looking at more detail to show that, hey, this was properly split. And that's what this line's talking about. There has to be adequate documentation to show how that claim was split into 2 things. By the way, the same thing could happen if part of the claim was written off as charity care and another part was written off as bad debt. We need to see that documentation. It'll flag as duplicate, but we'll dig deeper to find out what the deal is with it. Just another reminder that this does not include Medicaid length of stay limits. Those are handled on line 25. And before we go to column 2, I want to jump back to the questions here. So why are you asking for Medicare bad debts when they are written off the general ledger as well as when they are allowable bad debts, Medicare bad debts? So it won't actually, for line 26, we're only asking for them when they're written off the general ledger. We don't need the, let's say they're written off in 1 year on the general ledger. That's the year we need to see that on line 26. We won't need to see that Medicare bad debt on the S-10 listing in another year. It will, of course, show up on the normal Medicare bad debt that supports E-Part A, and that's fine. But the way the calculation works there, over that 2-year period, that it's going to essentially net itself out. I can jump back just briefly to show what I'm talking about there. Let me try to find that. So this right here, these line 27 and 27.01, they come from E-Part A. So what's going to happen here is when that 2-year situation, line 26 is going to have a Medicare bad debt that was written off of the accounts receivable in that year, but it may not have a corresponding amount that year coming through from line 27 or 27.01 because you didn't report on E-Part A yet. The next year, it's not going to be reported in line 26, but it will be showing up in line 27 and 27.01 that year. And again, it's going to net itself out over that 2-year period. It's just kind of an unfortunate difference in what date they're really looking for. It's that additional requirement for Medicare to have something returned from the collection agency before it's allowable for that 65% reimbursement. So it won't be a duplicate because it's going to be in one line 1 year and then the other line, which is some of an offset, the next year. So good question though. And let's see, we have another question. So if a self-pay patient receives a prompt pay discount, is that allowable in the policy? Yes, if it's in your policy, then that self-pay discount would be allowable. Are non-covered charges and the non-billable charges the same? Medicaid non-billable charges? I believe they would be. Yeah, I'm thinking they are. That phrase, I don't know, Ron, if you have anything to add there, but I believe that's just the same thing, two different names for the same thing. And can I confirm that a self-pay discount is not considered a courtesy discount? And yes, you're correct. It's not. It's not considered a courtesy discount. Therefore, a self-pay discount is allowable, but a courtesy discount is not allowable. What about Medicare bad debts for indigent Medicare patients where the balance is written off using a charity care code? Medicare bad debts. Oh, so very good point. That kind of goes back to Medicare bad debt in general. And unfortunately, charity care is used kind of interchangeably with indigent patients' bad debts. And I can see why. They're both based on financial assistance type policies. But for Medicare bad debt purposes, charity care itself is not allowed, even though an indigent determination is allowable. Extremely similar things. But to answer your questions, yes, they're if you wrote them off as a Medicare bad debt, then they would indeed be in line 26. They'd go through that, but of course they would not also be allowed as charity care. So that's the answer for that one. What it really boils down to is how did you write it off in your financial accounts? Did you write it off as charity care, or was it included in your bad debt determination? So let's see the next one here. For clarification purposes, during the sample analysis phase of an S-10 audit, any information provided as part of the charity care or bad debt that posted after the fiscal year end should, fiscal year end period being audited should not be considered for error since those transactions posted after the fiscal year end. Yeah, they would not. We'd carve them out of the listing up front, so they would not be in our sample. Yeah, we'd be carving that as an obvious error. Hopefully it wouldn't even show up on the listing after the query logic was completed. But if it did make it and it's an obvious error, then we would carve it out. Good question there. So the new account has line 20 charity that falls in both column 1 and column 2. Do we include two different lines for that same account on the detailed template? And yes, the answer would be we would need two separate lines there, because currently we look for whether or not it has an indicator whether it's uninsured or insured, and it doesn't allow two answers for the same line. So that one would need two separate lines. I will also mention that the templates that are in process right now that are in draft, they're changing it a little further. They're having two separate tabs altogether, one for insured, one for uninsured. So that, of course, would make it even a bigger reason why I'd have to have two separate lines. Should the self-pay discount be considered charity or contractual allowance? For our, it should be charity in this case. Anything that's an actual contractual allowance, that itself wouldn't generally be allowed for our charity care purposes or uncompensated care purposes. So this one, yeah, it should actually be charity care. But again, it's all about it being part of your policy. And when I say that, when I say it should be considered charity care, maybe that's a little bit of a misstatement, because the way the cost reporting instructions read, they do separate it out. They say report your charity care and or uninsured discount or self-pay discount. So CMS does see those as two separate things, but they're both allowed in the charity care line 20. So that might be the best answer for that one. Let's see here. Medicare crossovers. Yeah, if they're written off, well, those would be fine because they're written off the same year. Next question. No, the prompt pay discount, that is allowable. Prompt pay or self-pay discount, that is allowable. Also called the uninsured discount. those three things would be allowable per S-10 instructions as long as they're in your policy. Okay, so the non-billable charges, they're rolled into a contractual adjustment, therefore they will not be a separate charity adjustment. Okay. Let's see. Yeah, you make a good point. Lisa has a good point about the bad debts being reduced by the cost charge ratio. The question is, why is it presumed the bad debt should be reduced by the cost charge ratio? Like charity care, some of this is definitely copay and deductible. And you make a good argument that a lot of other commenters have argued in the proposed rule. In fact, this last proposed rule, but CMS basically has said at this time, this is how it's going to be reported. This is how it's calculated. It might be subject to change in future years, but at this point, all the bad debts that are non-Medicare are subject to that cost to charge ratio. So hopefully there's some sort of change maybe in future years. And yes, the query logic is definitely reviewed prior to the sample selection. There's a lot of time actually spent prior to that detailed testing because we would love to get a good clean listing up front as well. The big point I wanted to make though is we can't be doing that multiple stages throughout. We do that before we do the sample request. And then if we find any other obvious errors after that sample request, that's where the concern is. At that point, we likely will not be able to request a brand new sample and a new listing. So the goal is to try to get that all cleaned up before we even get to that point. So that's a good question there. The fiscal year ends 4/30/21. Do we think the new template will be finalized by this time? I would say probably not. It'll be this template that's currently on our website. It's probably going to be at least several months before CMS and the work group gets that last one finalized. And it has to go through public comment as well. So, and let's see.
Hey, Chris,
Yep.
I think there's a little confusion out there because there was an earlier question about prompt pay discounts for a self-pay patient if it's included in the financial assistance policy. I know according to the instructions, they specifically say courtesy allowances and prompt pay are not allowable for S-10 purposes. So I think the one question was kind of unique because it involved a self-paid patient and happened to be included in their financial assistance policy. But that's probably one we'd want to run by the policy folks at CMS to get a clarification.
Yeah, maybe just to get them to clarify that the self-pay. I mean, that itself is allowable. If it's now, maybe it's when they say prompt pay, your normal type of sales discount type of thing. I don't know why they'd be making a distinction there, but we could certainly look into that a little bit more, find out. But self-pay discounts or uninsured discounts are certainly allowable. So if the patient is going in there without insurance and they're making a payment themselves, that's by its nature an uninsured discount or a self-pay discount, which has been allowed. It's very clear in the policy for that. Oh, okay, yeah. So if you have a prompt pay discount for an insured patient, just their co-insurance and deductible, you're right. That's not necessarily allowable. That's no longer an uninsured discount. Maybe that was where the confusion was. I'm sorry, I misunderstood that question. It's only the uninsured related self-pay discount. Okay. And what I'm going to do here is I'm going to pick back up on the slideshow and then we'll come back to some questions in a bit. So let's see. We talked about that already. Talked about courtesy discounts, but self-pay or uninsured are allowable. Oh, must not be where we left off. Yeah, there we go. Column 2 are insured. So these ones, again, we're looking for the on or after 10/1/16, and we want to make sure we've carved out physician or professional, but they were uninsured patients who were given full or partial discounts in accordance with their policy, written off during this cost reporting period, regardless of when the services were provided. And this do not include charges for patients given courtesy discounts. So again, those are not allowable, or charges for uninsured patients with or without full or partial discounts who do not meet the charity care policy. So that's the key thing there. Also note that we're in column 2, which is insured, but here in this section it says charges for non-covered services provided to patients eligible for Medicaid, including those charges for days exceeding length of stay limit, can be included if it's in the policy. That's that piece I was mentioning earlier. For whatever reason, CMS stuck these within the insured rather than splitting them like they did everything else. Enter in column 2 the deductible and coinsurance payments for insured patients with a contractual relationship, so they're actually insured and they're covered that way. Enter in column 2 the non-covered charges for the days exceeding the length of stay limit. And of course, don't include anything that was already written off as a bad debt. So we have that. And let's see, column 2 is mainly for insured patients, private or public coverage. We've covered most of that. I do want to stress this though. So whatever amount in column 2, which again was insured, that you included charges for those Medicaid patients exceeding the length of stay limit, that same amount, it was included in column 2, line 20, but that same amount, just that portion, will also be included as part of line 25, which we'll see that in just a bit. Again, it's just the write-off that we're concerned with. And if the payment's made in the same year as the write-off, remove both. Remove the amount from the charity care and the payment. Now, here's the piece I want to talk about, and this, I think, answers that last question that just came up. Originally, CMS only allowed coinsurance and deductibles, and in fact, that's still what the cost reporting instructions say. They do not allow for anything like copay or anything like that. However, in one of the later years of audits, CMS did come back and say that even though it's explicit in the instructions, that was not their intent. So they've allowed co-payments now. Now, for all patients earlier, they were not, or for all providers earlier, they were not allowed. But now in these later years, CMS has said they are allowable. So a little bit of a change there. And usually the difference is coinsurance, tends to be a percentage, and co-payments tend to be a flat amount, but that's not necessarily 100% of the time. They're both patient shares. Again, we can include courtesy discounts or physician professional services. Now, here's the other thing I want to mention. For this column 2 insured, we're talking charity care, so we generally would not expect to see a Medicare patient included here because generally a provider would write that off as a Medicare bad debt. However, that's not an absolute disallowance. You certainly can't write them off in both places, but if you can prove, unless you have clear evidence, or if you do have clear evidence that for whatever reason that claim was not and could not be written off to Medicare bad debt in this year or any year, it didn't meet a certain policy, a Medicare bad debt policy, for example, maybe you didn't have proper collection effort or whatever, then it could be allowed here as charity care. But just the point I want to make is that requires that kind of higher bar of evidence because there's that concern of duplication either now or down the road. And then the template we have here, if it shows up, we're going to actually cover these in just a bit. So I'll skip through this slide. Payments. So going on to that one, this was another one that was a major change from the old instructions, but I'm going to focus on this year's instructions. Line 22 only reports payments in that year, payments received in that year toward a charity care amount that was written off in a prior year. Again, if it was written off this year, then neither of them should be showing up. So it's a payment against a charity care amount from a prior year. It's not a payment against the non-charity care amount that the patient just owes themselves. It's a payment against a charity care amount. Now, because of the nature of these, and relatively few patients would pay against something that was already removed off of their bill as a charity care. We know it does happen sometimes, but just by the nature of it, it's relatively rare. So these numbers are not necessarily expected to be very high numbers, but in any case, if they exist, then certainly they should be reported here. We've talked about that. And again, yeah, we talked about that as well. Here's a little bit of an example, but I'll leave it here in the slides for you to go through. I kind of talked about it earlier where they were approved for partial charity care, but not the rest of it. Some of their payment is going to go for the amount they actually owe. There might be an amount they paid against charity care as well. That's basically what this is going through, but due to time constraints, I'm going to skip over that example. We'll talk about the template just a bit. And then just briefly, I want to talk about line 24 and 25. So if you have that situation where you included some Medicaid length of stay limit charges in line 20, column 2, again, commingled with other coinsurance deductible amounts, then whatever that charge amount was that's up here in line 20, column 2, you also have to report it in line 25 so that the cost reporting software understands how much of this $385,785 from line 20, column 2, how much of that should be subject to the cost charge ratio. Because generally this number would not be subject to the cost charge ratio unless you put some charge amount in there. That's what this whole mechanism is for. It's an odd way that CMS built it. I'm not sure what the intent was, why they need this number so separated, why they couldn't include it just like you would include any other split claim up here. But for whatever reason, they did it that way. I do want to mention in the current draft cost reporting instructions that will be effective a couple years from now, they took it to another level and they added a line 25.01, basically saying, hey, for any amount for an insured patient that was non-covered for any reason, not just due to the Medicaid length of stay limit, but for any reason, use the same basic mechanism, only now use line 25.01 for those other amounts. We proposed to do away with both of these lines, 24, 25, and their new 25.01, and just simply split the claim between the two columns. Or if they really want to subscript line 20 into different categories of categories of charity care, we propose they do that. We think it'll be a lot simpler than this current mechanism, but ultimately it'll be up to CMS to determine what they propose or what they finalize. So that's what we have there. And we just covered this whole length of stay limit deal. That's just more detail. Continuing on there. And that's the same thing, just continuing on. And yeah, to answer that last question that just popped up, under the current CMS draft instructions, the amount for, let's just say, a non-covered or a patient that had some of the services non-covered, had nothing to do with Medicaid length of stay limit, but just a regular non-covered service. Currently, that's split between column 1 and column 2. Under the draft instructions, they're going to treat that the same way they do those length of stay limits, where everything would be in column 2 And then the charge portion would also be reported in that separate line 25.01 so that they know how much to subject to the cost and charge ratio. But again, we hope they don't go that route. We have proposed they don't. So we'll see. And let's see, we're at 48 here. We've got 20 minutes left. I'm going to jump back just to a couple questions before we get to bad debts. Let's see here. Is it acceptable to allocate charity care or bad debt charges between hospital and 1,500 based on the percentage of respective charges? Unfortunately, no. CMS expects that to be able to be identified by revenue code. And that's exactly why they want to see the listing split out by revenue code. They aren't willing to use a percent of total allocation. So that one would definitely be not allowable. And let's see. The auditors I've worked with are automatically removing any claim on the charity log that has a Medicare insurance plan. They shouldn't be doing that. Are you saying WPS auditors? We've definitely talked with them about that in the past. That it's certainly subject to a higher level of scrutiny, but as long as you can show that this was not written off to Medicare bad debt and it couldn't be written off because of some failure against the Medicare bad debt policy, it didn't meet collection effort or timely billing or anything like that. If you can show that, it should not be removed, if you will. It could be allowable as charity, obviously not bad debt though. So if you come across a situation like that, as long as you're able to support why it failed a Medicare bad debt criteria, that's all you would need to do to have it allowed as charity care. And yeah, we'll get to the charity assistance or the charity care policy discussion in just a bit here. Medicare Advantage. So yeah, that would be allowable as total bad debt, line 26. Of course, that's never allowed as a Medicare bad debt on E-Part A or anything like that, but it certainly would be allowed as a line 26 bad debt. So very good question there. Okay, I'm going to move on to the next slide talking about bad debts here. So, and we've really covered a lot of this, to be honest with you. Line 26 is both Medicare and non-Medicare. They're both net of recoveries. There is no currently an uninsured or insured split. I know there was that comment earlier, and there was even a proposal that they split this into uninsured or insured, so they have a better way of determining how much to subject to the cost charge ratio. That's just unfortunately currently not how the instructions work, but that might be a change in the future. The bad debts have to be written off during this period to be reported. Again, do not include physician or professional fees. Oh, by the way, I also want to mention, as far as both charity care and bad debt, one of the other major changes that they're making to the cost reporting instructions, or that they've proposed, is that it's no longer going to be the entire hospital complex. It's now only going to be just the hospital, none of the subunits, none of the RHCs, none of that. The argument, by the way, is that it's unfair to some hospitals that only have the hospital and no subunits. That's one argument. But the other argument is that DISH only relates to the main hospital. It doesn't relate to any other subunit. So why are we using subunit data for a hospital type payment? So who knows if that'll be finalized, but that's definitely a big change in the draft that affects bad debt and charity care. This line 26 continuing on, you certainly cannot include an item as both bad debt and charity care unless you have clear evidence that the charity care write-off was reversed. And if in that situation, we're going to need to reverse the charity care that period and include the bad debt that period, so the two will somewhat offset each other there. But we'll need to see the reason for it and the actual journal entry or the the documentation, basically. Now, this is what I alluded to earlier about the bad debts. Generally, this line 26 amount won't match the bad debt expense in your working trial balance or financial statements. And that's because most providers cannot use the direct write-off method. They have to follow GAAP, which currently requires the allowance method. And because of this, again, what's on your working trial balance or your financial statements is a allowance-based expense, just an estimate versus a write-off. But cost report line 26 requires the bad debt write-off, the actual write-off of that specific claim. We do require a reconciliation. That's something CMS requires, and we're required to look at it. And this is just a very rough, simple example of a reconciliation. It shows some older years. Get back to that here. So it shows some older years here, but it's still the same thing. There are a few different examples, and I think we have these linked on our website. You can either start by using the accounts receivable asset amount and showing how it's changed throughout the year, showing the patient revenues that came in on account, which would increase accounts receivable, show regular payments, which would reduce it. Basically, you're deriving the actual write-offs, because write-offs would end up reducing your accounts receivables as well. And then when you use that write-off, there are a few other things you need to reconcile against, like carving out physician bad debts, carving out bad debts from insurance companies, things like that. This is a simple version of the reconciliation, but it works. If you can come up with some other reconciliation to show how the amount on your financial statements relates to the amount reported on your cost report, that would certainly be fine as well. The templates we'll get to in a bit, so I'll skip past those. And now what I wanted to do is spend just a minute or two talking about the charity care policy, which I really think we've covered quite a bit up to this point. You can see that the cost reporting instructions have a lot of that, if included in your charity care policy type verbiage. This is part of CMS's required audit steps. And I do want to show an example of the template that we sent out here. Let me find that. It's not a template. It's the charity care reminder letter, if you will. It just shows, it was sent out 9/18 of last year, just making sure providers were aware of how important that charity care policy is. Let's see if this will come up in time here. There we go. Oops. This is the first one that came up. It went out to all hospitals. Word doesn't lock up on me. But basically, it says a lot of the same things that we just talked about. If your own policy allows for a certain, dang it. Sorry about that. My Word is locked up here. Okay, so if your policy allows for certain types of things to be reported as uncompensated care or bad debt, we just need to see that in the charity care policy. So it says failure to explicitly state whether a particular type of transaction is allowable in the hospital's charity care or financial assistance policy may put its allowance on the cost report at risk. As such, this letter is being issued to all acute care hospitals, most of which are currently undergoing S-10 audits. Again, it went to all acute care hospitals regardless of whether it was on our S-10 listing or not, just because any hospital could potentially become eligible for DISH. So the things to consider here are whether you allow uninsured or self-pay discounts, those charges for patients with coverage from an entity that does not have a contractual relationship, co-insurance deductible and co-payment related to insured patients, charges for non-covered services for Medicaid, And you can see the listing. Every provider should have received one of these. And it was not part of the initial information request. It was just because we were noticing quite a few situations where things were not in the policies. So we wanted to make sure that everybody was aware of this.
Hey, Chris, just to clarify too, because a question came up, hey, did all the Macs, send this out? We shared it with all of the Macs that are part of our worksheet S-10 work group, but I can't confirm that all of them utilized that letter and sent it out, but I know we did share it.
Good point. Thank you very much. So that goes back to, again, just the charity care policy. The other thing I wanted to mention that came up is make sure the policies have some sort of verbiage that very clearly identifies it as a charity care policy or a financial assistance policy rather than something that sounds completely different. So CMS stressed that during one of our rounds of discussions with them as well. Oh yeah, and I could certainly share, I could send this out as an attachment. I'll send another email when I send the recording link out, and I'll include that also. Now the templates themselves. So let me see, I think I had a copy downloaded. That might be a little quicker. Oh, yes, I do.
Oh, I apologize. This is Ron. It appears that we've got a little technical difficulty here. Hopefully, we'll have Chris back on here shortly.
Oh, can you hear me now?
Yep, sure can, Chris.
Okay. So yeah, the template we have here is linked in that PowerPoint slide. That's the link to our website, and you'll find the template there. But you'll see we have 3 actual tabs with the true listings. But then we have this new questionnaire, this query logic questionnaire. We started using that midway through the audits last year. And
hey, Chris?
Now we send them out. Yep.
Yeah, I was just going to say right now on the screen, we're just seeing like all the attendees. So if you got your slides back up, it wasn't showing. It looked like it flashed there for a second.
I could see the Excel file.
Okay, well maybe it's just me, Chris. Sorry about that.
There we go. Yeah, the Excel file's up now on my screen.
Okay, thank you very much.
Oh, sorry about that. We have I know we only have about 6 minutes left, and we've got easily another half hour, maybe even an hour that we could discuss things with. So I think what we'll probably do after we discuss this one piece is we may set up a follow-up webinar in the coming week or two, just to cover the remainder of this portion. But I think what I want to spend this last 6 minutes on is this query logic questionnaire, because this is the piece that really sets the stage for the audit. We think this is good training for the providers while they're putting the listing together, and we believe it'll help to eliminate a lot of those more obvious errors, so that by the time we get to our detailed sample selections, it won't be as much of a concern about what's getting extrapolated, because they hopefully won't be any more obvious errors. And that's what this first paragraph really says. It's not required, but it's strongly recommended. We do require some sort of query logic discussion, and this serves the purpose of that. So we have this broken into charity care, first of all. And the question is, how did you generate your listing to ensure that it only includes charity care amounts written off this period? So right away, if the provider answered this question and they followed it, then we shouldn't see that obvious error anymore when we get the listing. How did you ensure that no charity care was duplicately written off in the current year and in any prior years? So we need some explanation for that. And it just points out the fact that that's not allowable, that you need to watch out for it as well. What transaction codes are used to identify charity care write-offs versus other non-allowable contractual adjustments? This is more just giving us a legend, what codes do we expect to see? What methods did you employ to ensure there were no claims reported in both the charity care listing and the bad debt listing? Now, again, if you have partial claims in both listings, that's fine, and you could certainly respond something to that effect, but we just need to see the fact that that could exist. Line 5, do you have any Medicare patients that are reported as charity care on line 20? And if so, how did you ensure that those claims were not written off as bad debt? And explain why. Again, they didn't meet a certain Medicare bad debt criterion. Number 6, what about those that have exhausted their benefits? Have you split the claims between column 2 and column 1, just like we talked about earlier? So these are kind of little notes or points about, hey, make sure to do this or that. 7 is all about non-covered services, but the same basic thing as 6. 8, again, very similar to this, although these are related to the non-contractual relationships or no contractual relationships. How did you ensure that these charges are reported as uninsured? Is there a particular code you use? Number 9, this is the length of stay limit, and it reminds you that this goes in both column 2, line 20, and line 25. 10, self-pay or uninsured discounts. They're allowable, but explain what section of your policy explicitly allows this. Line 11, how do you ensure there are no physician or professional services? 12, this goes, when we get to the templates, this will make more sense when we add up the various columns. So we'll talk more about this in the next session. And 13 is the same basic thing there. 14, I do want to touch on, though, about the presumptive eligibility. That's never allowed for Medicare bad debt purposes, but it is allowed for charity care as long as it's in your policy. So presumptive eligibility based on some vendor, some software, some other simple eligibility verifications, things like that. Line 15 has a couple of items. Any patient payments reported on line 22, again, they're only reported against charity care, written off in a prior period. Just kind of training a lot of the same things we've covered up to this point. Does your policy discuss how you handle those payments? Are they returned if it was already related to charity care, or does it reverse the original charity care entry? Please provide an explanation. And then, as you can see, we have quite a few left. I know we're down to our last minute. So I think what we'll do is we'll end the session here. And in our next follow-up webinar, we're going to start with the bad debts portion of this questionnaire, and then we'll move over to the actual templates and the remainder of the PowerPoint slide. And what I'm going to do is I'm going to copy all of the questions that have been asked on this current chat area. I'm going to save them in a separate document, and then whichever ones we didn't get a chance to address, we'll do so then, as well as any new questions that come up. So it's right at 3 o'clock Central right now. I just wanted to thank you for your time today, and I'll be sending out some information on the follow-up meeting. What I'll probably do is just send that out via email. You don't necessarily have to go re-register for that. That way it's a little simpler for you. But thanks for your time, and I'll talk to you in a later session. Have a good day.
Yeah, thanks, everyone. Thanks, Chris.
Thank you.
Thank you.
You bet.